Welcome to the Investor Coaching Show. Here's your host, Paul Winkler.
And welcome. This is the Investor Coaching Show. Paul Winkler. Talking money and investing. Walking through the news of the week. And using it as best I can to educate about the investing world and what's happening in it. I'm doing a lot of research this week, just kind of putting numbers together. Because that's what I do. But there's been some interesting news this week, and we've done some research on some of the things being talked about. As a matter of fact, one of the things I'll be getting into some of the technological breakthroughs that are supposedly happening out there. I say supposedly happening because some of the reporting on it was actually said to me by somebody who was telling me about it, and I said, wow, that's really, really interesting. So we went and looked up, and Scott up here in the Goodlettsville office actually went and looked at some of the research being done and puts together some stuff for me that was really, really good. Because I wanted to see, hey, how do we think about this stuff? What's actually happening? And I'll get into that in just a little bit. Also, some of the data on markets this year, I think is interesting. Just, what's going on in various markets. One of the things that I find with investors is so often these mistakes that people make with regards to investing, it's a lot of it sounds good. And you'll hear various strategies being thrown around. You ought to try this strategy right here. This is a really good strategy for protecting yourself as an investor, or maybe this is a really good strategy for maybe sounds something very sophisticated regarding how do you do things from a tax standpoint. Sometimes what people do is they, as I like to say, they let the tax tail wag the dog, so to speak. So they'll hang on to something, they'll hang on to an asset they should get rid of because they're going to be avoiding taxes by hanging on to it versus getting rid of it. But there was a commercial that I heard this week that I thought I got to share this with you because this is really good. Just check this out, and I'll just make a comment afterwards.
Crypto markets may be down this year, but there is one silver lining: tax loss harvesting. Tax loss harvesting involves selling positions that are in the red and rolling into an alternative exposure. So if you're down on Bitcoin, why not exit that position and find a new crypto asset to invest in? That lowers your tax bill for this year, but keeps you involved in the crypto markets. And that's one thing to know about crypto.
So you see a commercial like that and you think, hey, wow, what a great idea. This thing that got you into trouble and it was a bad investment? Well, you know what? Let's make lemonade out of the lemons, and we're going to sell it and be able to have a loss on the books, and then we could write that off against income and maybe against capital gains if we got them any place this year. And then what we'll do is we'll reinvest it in what? Another thing that isn't any good. So it's just the definition of an insanity, right? Doing the same thing and expecting a different result. So it's like I watch this stuff on TV and go, what are people thinking? I don't know. I don't know that anybody really knows what they're thinking. But a lot of times we see this kind of thing. Hey, you really ought to do this because this would be a really good strategy. And people will come in and they'll say, hey, Paul, what do you think about investing in gold? Because they've seen the commercials on gold. And I'll go, have you watched what gold has been doing? And they're like, well, no, not really. But I see the commercials, and it seems to make sense that I should invest in a hard asset like that to protect my money against inflation. And, I did this with somebody this week. I said, okay, let's do this. I said, I'm not going to tell you what to do because they asked me that question. Should we be doing that? And I said, I'm going to have you answer your own question. And I said, so let's say that the price of gold goes way up and the dollar drops in value and you have a lot of dollars for your gold. So you get a lot of money. There's a lot of money to be made by selling an ounce of gold. As a rational human being, let's say that you are in the business of mining, and right now it's not practical to go on land to find more gold, but there are other places that you can find it. And I says, so what would you do? Would you put more money into mining? And they said, well, yeah, no question, I would put more money into mining. I said, so you'll put more money into mining, and then you'll do what? You'll hopefully what? And they said, well, I find more gold. And I said, oh, good. Okay, so you'll increase the supply of gold. And they said, yeah. And I says, what happens when you have more of it? What happens to the price? And they go, well, it goes down. And I said, good. Okay, so you answer your own question. They just laughed, and they said, yeah. But then I get people asking about interest rates going up. And I'll go, okay, so interest rates went up, and what are you going to do now? Well, I think, what I'm thinking about doing is putting more money in higher interest rate investment vehicles. And then, what I'll have is this same conversation with people. So you go and take your money out of what? Stocks? Yeah, take it out of stocks. And then you'll put it in fixed income investments. And, now if the interest rate's 3%, you're only losing what? 4%, right? After inflation. Well, my inflation rate's different. Sometimes you hear people say that. Well, yeah, you might have a lower inflation rate right now. But, if the dollar keeps going down in value, it'll catch up. You'll have different inflation rates. In other words, if you look at the basket of goods that you buy versus what somebody else might buy, your inflation rate will be different from other people's. And maybe in the short term, your inflation rate is actually lower than what somebody else's inflation rate would be. But eventually, everything goes up in price. If we have broad-based inflation, everything goes up. So maybe right now you're not seeing huge increases in the price of, let's say your telephone bill or your, heating. You might have electricity and energy can fluctuate, and a lot of times the inflation rate it actually excludes food and energy, right? Which a lot of people say, well, that's real convenient, but it is. Those two things are volatile. But, you can have a different inflation rate for a while than other people, but you're looking at something that will not have the ability to stay pace with inflation. It's a fixed income investment like CDs or savings accounts or annuities that are fixed annuities and things like that. They're giving you a fixed return because they're bond backed. And if we go back 100 years and we see that the rate of return has been at or around inflation. Now, if we look at stocks, we see the return being above inflation historically. Large U.S. stocks, about 7%, right? Small, about 12, or about 12 before inflation, 9 after inflation. And then you've got value stocks, 8, 9%, somewhere in that neighborhood after inflation. Small value, about 11 or so. So these various asset categories historically have a return above inflation because what's inflation? Prices going up. And what companies do, they will raise prices in order to cover the fact that the dollar is going down in value. Now, if we look at this and we say, okay, so but the rate of return on the CDs and the short-term stuff has been higher than stocks have been over the past year and a half, right? And yeah. Now, some areas of the market aren't down much. I mean, you look at some areas of the market, they're very, very small downturn so far, this year through to 2022. But everything, if you look at it, markets around the world and inside the U.S., everything is down in general, right? And what happens is it goes down and the price goes down. And what happens is people pay less for every dollar of earnings. So they're paying less for every dollar of earnings. So let's say that you used to pay $20 for $1 of earnings. I get $1 of earnings for every $20 I pay. 1 divided by 20 equals 5%. So that's my earnings yield. Now, if I look at it and say, well, I'm not going to pay $20 for the dollar of earnings. I'm only going to pay $10. Well, what has happened? 1 divided by 10, 10%, my earnings yield has gone up. And when you have markets go down, what investors are doing is they're saying, you better pay me more to use my money going forward. Now, so when somebody's buying that stock from you or those stocks from you, they are actually paying a lower price, which gives them a higher earnings yield. Now, Warren Buffett basically said stocks are bonds in disguise. What you're buying is the rights to the earnings, and those earnings are going to be higher compared to the price that you pay. It's another way of looking at it. And therefore, the earnings yield is higher. Investors are going to be rational. They're going to look at it and go, oh, well, CDs are paying, let's say 2% or 3%. Let's just use those, or some kind of bond may be paying that, let's say. What they're in essence saying is, if you're going to get me to take the risk of stocks, I need a return that significantly exceeds an expected return that significantly exceeds that 2 to 3%. Because I can get 2 to 3% with no risk at all, no volatility whatsoever. So the expected future return would have to be a lot higher to entice me to buy those stocks. Now, if we look around the world right now, there are areas that are selling, outside the U.S., $7 for every dollar of earnings based on a forward basis. And what that means in English is that, as, let's say, an analyst would go into a company and they're going to look at the company and go, well, okay, what are their sales projections? What are they selling? How do they look as far as unemployment goes in the future? Are they going to be decreasing staffing? If they're going to decrease staffing, that will get rid of some expenses, so therefore that would help with earnings. How are their sales looking? How are their other costs doing? Are they finding ways to maybe find different suppliers for things that they make, whatever their widgets are, whatever they make their widgets out of? Are they finding ways to find cheaper suppliers for these things? And a lot of companies are. They're going to other countries for supply chain issues, and maybe it's because of political issues like China, for example. Maybe it's the concern about Taiwan. If you're looking at that and going, well, if China comes in Taiwan, we got to have some other suppliers. So even Taiwan's Semiconductor is looking for alternative ways to actually supply things and not interrupt their ability to produce things. So therefore, what happens is that companies are looking for everything they can do to reduce expenses and everything they can do to increase sales, and how they can get away with increasing their pricing so as to get earnings to go up. And when we look at all of that data, when an analyst goes in and looks at all of that data, they come up with a forward earning estimate. In other words, what do we think earnings are going to be over the next year? And that's the number that I'm always looking at. Because you can hear people talk about PE ratios and say, oh, market's high, PE ratios. And a lot of times what they're talking about is backward looking. They're looking at the prices right now based on earnings before. Well, what do we know about earnings over the past year for a lot of companies? It's been really good. So the earnings number would be high compared to the price, or you might have some companies that the earnings are very, very low. So if the earnings are low and they didn't have good earnings over the last year, their PE ratio would look totally different, because the price, the denominator, would be very high compared to the earnings. So let's say that $1 of earnings with one company versus $10 stock price, $10. But if a company had low earnings, 50 cents to $10, well, that puts the ratio back at 1 to 20. 0.5 is to 10 as 1 is to 20 in math. So in essence, that would look very, very expensive. So you can get really fooled by looking at backward-looking price to earnings ratios, or earnings to price in this particular example, the earnings being on the top versus the price. So hence what happens as an investor, I can get really, really sideways just looking at and trying to figure out whether the price is high versus low, or if it's something that tells me I should be buying or selling or whatever, and I could be completely looking at the wrong data. Now, even looking at price to earnings ratios simply is problematic, because price to earnings ratios only tell me about what is going to happen or what is likely to happen over the next calendar year. So the next calendar year may not be indicative at all of what will happen in year 2, 3, 4, 5, or whatever going forward. So it really can get you as an investor to just look at that. So what happens when somebody puts all their money in and says, hey, I think I'm going to slide it a little bit more in here because I'm getting a little higher interest rate on this CD than I did in the stock market over the last year. Two problems with that. Number one, you're assuming that the forward returns of the market will be lower than what the CDs have or are going to pay, or the fixed income investments, whatever they are going to be over the next year. Number two, and this is the trickier part about it, you are engaging in market timing and probably not willing to call it that. Because market timing, by definition, is any attempt to change the mix of your portfolio based on a prediction or a forecast about the future. You may not think of it as this, but predicting and saying things are going to get worse going forward, and then saying, oh, the stock market's going to be bad compared to fixed income investments, is a prediction about the future. It is a prediction, really, because if you look at the earnings yields of some of these things that I told you about, 1 divided by the price, right? Some of this stuff, like I said, is $7. That's over 10% earnings yield. So you're assuming that top number, which is put together by the best minds that are analyzing companies to figure out what earnings are likely to be, and we're talking about people that really, really dig deep. You're saying that that's wrong, and that they are completely wrong about what that number is on the top. Because let's say, just for argument's sake, so you get this, if I've got $1 that I have expecting that it's going to come in, and I pay $10 for it. Remember, earnings yield is 10%, right? 1 divided by 10. What I'm saying is I think, the earnings is probably going to be 50 cents. It's not going to be $1. And then therefore it would be 0.5 is to 5. So the price went down to 5. It went from 10 to 5. So I'm assuming that I know better what those earnings are actually going to be, and therefore I'm moving away from that. Well, the reality of it is that is the best estimate. Could they be wrong? Absolutely, they probably will be wrong, but they could be wrong, to the downside or the upside. But if we look at what the expected return, that's why you always hear me use the big E word. The expected return is based on all the data that we can have, knowable and predictable information. The earnings are expected to be $1. And if they come in at $1, my earnings yield was 10%. Now, if we look at around the world, there's a lot of bad stuff that's going on and that has been going on, and that's why the prices are so low. Investors demand a higher expected return and therefore get that by paying the lower price. That's how they're shooting for that higher expected returns, by paying a lower price so that the earnings yield is higher. So when somebody does that and says, I'm going to shift over to here or there, I remind them, look, your market timing. Now, what's the problem with market timing? We know that professionals, and I've done this many times, they can't get returns higher than the market. Now, they may do it if you look at like the one year numbers, I think, versus of investment managers trying to beat the S&P 500. It was somewhere in the neighborhood of 45% did. Well, why? Because the market's down so much, and what happened is some people maybe had some cash and they in the portfolio, so they actually did better than the S&P 500. But here's the problem. You go out 10 years, and it's well less than 10%. It's like 5% of investment managers actually had a higher return than what the market did on its own. And then we're talking large U.S. stocks here. What does that tell you? That tells you that not too many people beat the market, number one. But number two, that tells you that the people that did beat the market over the past year, there's a high incidence of those people thinking that it was something other than luck, that it was skill. And it is very hard for our egos to actually take the idea that when we do beat the market, that it wasn't skill, that it was just luck. Because our egos don't like And, we don't like saying, well, I'm not very good at this either. No, that doesn't settle really well. So what we do is we attribute it to skill, and then we've had ourselves on the back until we underperform. Then we shut up about it. You don't say anything about it at that point, right? So as an investor, the question, what do I change? What do I do? What do I do differently? And many times the answer, if you got a properly mixed now that's a big if you've got a properly mixed portfolio and it's well allocated and it's prudently mixed, maybe the answer is nothing.